But all this means, by the way, is that the Fed doesn't understand what it's doing, and it's not watching the money supply. Its narrative is not my narrative at all. Its model is not my model at all. Mine is a monetarist model, a quantity theory of money.
So why is it that all of these central banks focus on the rate hike or cut and not as much on the money supply?
Because the quantity theory of money, although it's been the traditional model that's in all macroeconomics until about 30 years ago. About 30 years ago, macroeconomic models started changing and kind of drifting into what I call various forms of post-Keynesian models, not monetary models. And so all the young people working at the research department at these central banks, they were trained with post-Keynesian models. Those models don't even include aggregate measures of the money supply. Now, how can you be running a central bank and are having a macroeconomic model that doesn't even include money? That's the one thing that central banks produce. I mean, it's kind of bizarre. I mean, quite frankly, it's stupid, but I'll use the word bizarre and be polite. So money supply goes up and inflation goes up. Money supply comes down, inflation comes down. So this is the monetarist view of things. It's the monetarist quantity theory of money model, and it's a monetarist narrative. But that's not the narrative you're hearing from Powell, because the Fed rejects monetarism completely. The Fed says there's no connection between changes in the money supply and changes in economic activity and changes in inflation. And that's what most of the big central bankers, you're up there, actually you're in New York, but Kitco's in Canada, and the Canadian governor echoes exactly what Powell says. The Bank of England has been saying the same thing. The European Central Bank, the same thing. They reject what I just said, that there's a link between the money supply and economic activity and inflation. But they're wrong. They never predicted, by the way, where inflation's going. I mean, right now, Powell is holding a trophy in his hand for being a genius for wringing inflation out of the system without giving us a recession. But the reality is the reason is because the money supply has been contracting, and it's growing at a very slow rate now, Michelle. The money supply in the United States year over year is growing at 1.26% per year. And Hanke's golden growth rate, a rate consistent with hitting the Fed's inflation target of 6%, of 2%, is a growth rate in the money supply of about 6%. Golden growth rate, 6%. That's where the money supply should be growing if you want to hit the inflation target at 2%.
Professor, help us understand then what impacts the money supply. What policies lead the money supply to either expand or contract?
Well, a couple of things. One is what's going on with the size of the Fed's balance sheet. If the Fed's balance sheet is expanding, they're buying government bonds. And when they buy government bonds, they issue credit to the government to pay for it. And that credit to the government, it's part of the money supply. The money supply grows. The other aspect right now is that they're in quantitative tightening. They're shrinking the money supply because they're shrinking the balance sheet of the Fed. They're not buying bonds. They're letting bonds mature, and that is causing the money supply to decrease because the government still has to sell the bonds to somebody. They sell the bonds to the non-bank public. And when they sell the bonds to you, Michelle, or me, we have to write a check. We write the check and we get the bond. But what does that do? That reduces our checking account, and the checking accounts are part of the money supply. So that shrinks the money supply. So that's part of the picture. The other part of the picture is the commercial banks and whether the commercial banks are loaning at a high rate or a low rate. Because commercial banks create most of the money. Most of the fiat money actually created is by commercial banks. And right now, the loan growth is only about 3% year over year in the United States. So the commercial banks they're loaning, but at a pretty slow rate.
Fed Powell was asked about the recession specifically, and he is still pushing that we could still hit the soft landing narrative. If we have that soundbite in the recession, I'd like to play that for you and get your thoughts on that.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No.
All right, he doesn't really see that. I'll remind us that this is the same guy that told us inflation was transitory. But what do you make of that? Why does he not see it? Why are they not looking at the same data that you are?
He doesn't see it, Michelle, because the Fed is not looking at the money supply. So if you're not looking at it, how can you see it? He's flying. He's what I keep saying. The Fed's flying blind.
But respectfully, I get that you said that this is a different, school of economic policy, but surely when you have all of this collective education and brain power at the Fed, I mean, surely someone should be saying, hey, let's look at the money supply as well. Why do you think that as an indicator is so entirely dismissed?
I think for the reason that I gave you early, all the theoretical models and the training of the graduate students that are in the research department.
But Powell's not that young.
They're trained with models that don't include the money supply. They're called post-Keynesian models. That's one aspect. The other aspect is ideological, and that is most of the employees in the research department, they're over 700 economists that work in the research department at the Fed, a huge staff in the Fed, in the whole system of all the Federal Reserve banks, including headquarters in Washington. So the vast majority of these are Democrats. The vast majority of those are Democrats. Now, why is that relevant? They're not Republicans; they're Democrats. And the key there is that the dean of monetary economics happens to be Nobel laureate Milton Friedman, who of course everybody knows of, and he was a big time Republican. And he influenced the Republican presidents enormously, including the president that I worked for, Ronald Reagan. So Milton Friedman is kind of the guru of monetarist and monetary theory and the classical monetary quantity theory of money. And so he's kind of ideologically, he's kind of the enemy. He represents the enemy. And he represents the enemy of Democrats. Well, if all the research department, almost all of them are Democrats. So you get the picture?
So it's again this sort of major ideological division that we're seeing in the country at large, I think, on many issues.
I think it does come into play. It's a little bit more subtle, by the way, than the kind of primitive divisions that you see in the public today. The one I'm talking about is actually quite a bit more subtle and sophisticated, but it's still it's a division, and it is real, by the way.
I'm sure it is. I mean, we've also, we've got the likes of people that push for MMT, which is a very, you could say, left-wing idea that you can just continue to print and print money. Modern monetary theory.
Modern monetary theory, of course, completely rejects the quantity theory of money and what I'm talking about right now. That's kind of an extreme form, but in a way, it's an interesting one because it's very transparent. Once you get into the post-Keynesian models, you're getting out into the technical weeds, and it's hard for people who aren't really trained formally in economics to even know what you're talking about. But modern monetary theory is a little more easy to grasp for the average Joe or Jane.